Good morning. Happy Friday. You have made it to the end of the week. Well, almost. It's still morning. Uh, Go ahead, grab your favorite drink. Today we got a fun one we're going to talk about. I'm going to teach you how to calculate exactly what you can afford and how we do it as a loan officer so you don't have to stress any step of the way. So go ahead, grab your favorite caffeinated beverage and let's get this started.
It's Finance Friday, I sure in the spot, talking loans, home deals, giving all I got. Rates, hacks, facts, yeah, we keep it real. From first homes to refis, helping you seal the deal. Mortgage talk, but we make it fly. No jargon, just the truth, I'll tell you why. Finance Friday, get your questions in. With the Sure on the mic, let the answers begin. Let's break it down.
So, good morning. Good morning. Hope you are doing well today. It's almost a holiday weekend, which I know means a 4-day week or 3-day weekend for some of you. And I know we're excited. So, as I said earlier, today we are going to be talking about how you can prepare for the home buying process, essentially pre qualify yourself without having talked to a bank, a loan officer like myself, because even though we try to make it as stress free as possible, it's still a little nerve wracking sometimes, right? Especially when you're having to show some details of your pay and your bank statements, and it gets quite personal. So, I know a lot of times people come up and they ask, hey, how do I do this? How can I get qualified? Or is there any easy way? And today I'm going to show you how to do that live. And we're going to go step by step, everything I tell everyone I work with to do. I'm just going to tell you, the viewer. So let me go ahead. I'm dealing with a few extra things. Oh, also, side note, I was expecting to have a guest on today. That got postponed due to unfortunate circumstances. So, next 2 to 3 weeks, you can expect that guest to come on. I'll let you know as I know more. So, the first thing you need to do before you start doing anything of what I talk about, or even if you want to just go straight to a bank and have them do all the hard work, or come talk to me, let me do all the heavy lifting. The first thing you need to do is protect your privacy. Now, thankfully, Trump signed off on a bill that was passed through the House and the Senate to eliminate trigger leads. But if you haven't applied for a mortgage in the last couple of years, it's a nightmare. You'll get your credit pulled from your loan officer, and that loan officer could be your friend. It could be a trusted resource. And within 5 minutes, you've got 60 missed calls. You got 20,000 text messages. And I wish I was being hyperbolic. I've had people get over 100 calls in less than 2 days from other loan officers and other banks that got note, hey, this person pulled their credit, check in with them, right? That the bureaus sell that data. Well, 6-7 months from now, that won't be no more, but we're still 6-7 months away. So protect your privacy. Well, what does that mean? Well, I'm glad you asked. The first thing I want you to do, sorry, there's a little more moving around and I'm a one-man show, so I apologize. First thing you need to do is you're going to hop over to, optoutprescreen.com. And it's pretty easy to do, right? Essentially, what you're doing is you're opting out from anyone being able to use that data in order to reach out to you because your credit got pulled by someone else, because it does get annoying. I'm going to be completely honest. And then the second piece I want you to do is register yourself on the National Do Not Call Registry, right? I'll have links to all this in the descriptions, or you can reach out if you want more info. But put yourself on those two first, the opt-out pre-screen and the donotcall.gov, to get yourself put on there. That way, it prohibits people from calling you, solicitors to call you. And then note, if you're on these lists and they still call you, the penalties are pretty harsh, up to $10,000 per time it happens, every single time. So if they send you a text and then another text, it's potentially a $30,000 fine they might incur. So protect your privacy. Step one, please, please, please do it. Signing up on the Do Not Call registry and also on optoutprescreen.com. Pretty easy. Cool. So that's step one. Step two, check your own credit. You don't need a bank. You don't need a loan officer to check your own credit. Now, Credit Karma is fine. It serves a purpose. It's easy to use. But Credit Karma does not look at the things that banks and lenders will look at in full. I've seen variants of 50, 60, 70 points. Someone coming in saying, hey, I've got a 740, and we pulled their credit. They got a 610 because there was something on there that Credit Karma didn't care about. So how could you figure out what's being reported? Well, I got two resources for you. The first thing you want to do, and this was the screen that was mistakenly up at first, annualcreditreport.com. Hop to annualcreditreport.com. You can get a free credit report once a year. This is the only source for it that's authorized. And note, this is not a hard pull. Well, what does that mean? Well, it's going to give you a look into your credit report. It's going to show you if there's any surprises, hopefully not. And then it's not even going to ding your credit, right? It's a soft pull. It's not a hard inquiry. It's a soft inquiry. You could do that once a year. And it's a good insight. And then if you're talking to a bank or a loan officer, this is something you can provide them, right? It'll expedite the process. And then the second thing is you can actually request your credit score. So this credit report won't give you your score, but you can request your credit score from each of the three bureaus. I would recommend TransUnion, right? You can go to all three of them. You can go to TransUnion, and you can obviously pay, but don't do that. Just get the one free score. And now when you go to talk to a loan officer or a bank and say, hey, where are your rates at? Or if you're on an online system that they provided, you now not only know, hey, my credit history looks good, there's no surprises, but you also now know my score is whatever it is, 680, 640, 720, etc. So keep that in mind. Those are the two things you can use, and you can check all three bureaus, but I've found TransUnion be the middle of the three each time more often than not. And because of that, save yourself some time, just get your score. Gives you an idea of where you most likely are. Pretty easy, right? And now you've done two things that drastically now make you a smarter buyer moving forward. Whoops. Cool. So now, this is kind of the fun part. Step 3. The other thing that banks and lenders we care about, and this is primarily the meat of our job, is we calculate your debt to income ratio. Now, there is a lot of nuance that goes into this. I'm not going to get into it here on a live or on a short video because that video or this live would now turn into a 2-hour segment. But I'm going to give you a basic overview on how you can do this on your own. So I have a new setup. Let me see if this works. Nope. Sorry, bear with me. That's the website. Add this. All right, we'll make do with this. Sorry. Perfect. So I've got my little pen and paper here. I'm going to show you how I would do this talking with someone. And more often than not, I'm not collecting documents. I'm not doing anything official until I do this, what we're doing now, with the client, with the borrower, with whoever's looking to buy. Because I want to make sure you know what you qualify for before I make you do all the legwork and heavy lifting. So, income. If you're self-employed, it's going to be a little different. If you want a general idea of how you calculate your income if you're self-employed, well, just take essentially what you reported on your Schedule C or your 1120S as income, divide by 12, and it's going to give you a rough estimate. Please note, that's going to be a small estimate because there's a lot of stuff when you're self-employed you can add back in to count as income. Some of those deductions, not all of them. But right now we're speaking in generalities. Just take that reported income, the net income at the end, and use that moving forward. If you're salaried, it's pretty easy. Just take whatever you make. So let's say you make $60,000. Just divide it by how many months there are. 12, in case you didn't know. 12 months. And that's going to give you your monthly income. Because when it comes to mortgages, your monthly income is the thing that matters most. Here, let me zoom in a little. Perfect. Move my mouse. So pretty easy. If you're hourly, this is where I'm going to show you a little neat trick. Whatever your hourly amount is. So let's say you make $20 an hour. Yes, there is a way you can calculate this correctly. However, I'm trying to show you the quick and easy, the quick and dirty way, right? Just take that hourly amount, double it. So 20 times 2. For all you mathematicians out there is 40. Once you've doubled it, add a few zeros. And that's roughly your annual income. Now, once again, I'm showing you conservative ways to calculate it. Your number will actually be higher than this, but it's close enough to give you a guideline of where you're supposed to be or where you should be. And it works for everything. Let's say you're $32.50 an hour, right? A little trickier, but we can still multiply it. So $32.50, 32 and 2, 64. 50 cents is another dollar. So $32.50 times 2, $65. Add a few zeros. Now you're making $65,000 roughly every single year. Once you have your annual amount, this is where you go ahead and divide it by 12. So if we were going off the $65,000 divided by 12, that's going to give us about $5,400 a month, right? Now, the monthly amount is what the banks care about. And moving forward, that's kind of what we're going to talk about, because with that monthly amount, and this is going to vary from program to program, but you're going to roughly be able to get qualified for up to half of that monthly amount for all of your debts. I'm sorry, I know I'm looking off screen. I've got two screens, and of course, the camera is not on the screen I'm looking at. But you're going to qualify for half of that monthly amount with every single piece of debt you have. So let's take that $5,400, cut it in half. That means I can qualify for about $2,700 of debt every single month. Well, what goes into this? Not everything, but quite a few things do. Here are some of the more popular ones. Student loans. Let's say you pay $200 a month on student loans. Car payments is probably the biggest one I see. Let's say you've got a $300 car payment. And then credit cards do count against you, but it's not your balance that counts against you. It's the minimum monthly required payment. It's typically around $40 to $50. So for this example, we'll keep it easy. We'll just do $50. And that's per credit card. So let's just say this person, this hypothetical we're dealing with, they make $5,400 a month, $200 in student loans a month, $300 in a car, and one credit card in their name, and they've got $50. Utility bills don't really count. If you have I don't know, there's a bunch of other debts you could have that don't count. But if you have like a layaway, that's going to be a factor. If you, let's say, co-signed for someone on their car, that could potentially cost or count against you. So any debt that is on your report, which you will see because you already pulled your free credit report, that's going to count against your monthly debt to income ratio. Once you figure out all your debts, just take it away from whatever your monthly income is, the half, the 50% of it. So if we have 27 minus 2 is 25, minus 3 is 22, minus 50, this means we can qualify for about a $2,150 a month housing payment. Now, notice I said housing payment because your payment that you can qualify for that's left over isn't just your mortgage. You still have properties, property tax, you have insurance, there might be private mortgage insurance, you might have solar, there might be HOA, all that is applied towards that $2,150. But at least now I know roughly what I can qualify for when it comes to a housing payment, right? Taking my income, figured out how to get the monthly. Now I'm working towards the payment. Well, okay, well now what can I do with that? Easy. Next step, let's estimate our housing payment. Well, how do we do that? I'm glad you asked. We're going to go back to our screen real quick. And the first thing I want us to do, and this is a resource I tell my borrowers about, and I also send it to realtors too, is there's a free, excellent resource, Mortgage News Daily. It's not the most exciting thing, but if you're house shopping, it could be. And on here, you're just going to use it to see what is the average for today, right? So you can see that yesterday's average was about 6.62% for a mortgage rate. And if you look up here on this little tickers up here, you can see that rates are actually getting a little bit, they gotten a little bit better today, right? There's a lot of good resources. So we can go to the MBS. There's today. Whoops. Rates have gotten better, right? Powell just had his speech. He's saying, okay, yep, we're moving forward with the cut. Market's reacting positively and favorably and should for the next couple of weeks. Now, there are some floors that we need to get through, but for generalities, we're just trying to figure out what's the rate going to be. Now, take the average, 6.62, and now I know my average, my odds of getting a mortgage is going to be about 6.62%. If your credit score is lower than average, expect a higher rate. If you have a lower down payment, expect a higher rate. If you have a good down payment or great credit, expect a lower rate. If you're doing an FHA loan, you can also expect a lower rate. But we've got a baseline, 6.62%. Let's just call it 6.6, right? Now, here's the next piece I want you to do. Find houses in your area. What's even out there, right? But before you do that, because I know that's the fun part, we're going to go to another free resource. And everything I'm showing you, by the way, is free. You can do it with a pen and paper, calculator if you need it, and then some websites that are all free. I don't pay for any of this. The next one is no different, mortgagecalculator.net. There's other ones that cost or they're signed up with someone, but this one's quick and easy. You don't set anything. You don't have to sign up for anything. Just make it easy. So let's say, okay, what does that $2,150 get me? Well, I got taxes, insurance, and potential HOA. So maybe let me shoot for a $1,700 a month payment. If I know the interest rate's around 6.6%, let's just start. And this is some guessing and checking, right? There's easier ways to do this, but I'm trying to show you an easy way you can do it without having to know all the mortgage jargon. So if I'm aiming for 1,700, okay, I'm well under. So let's adjust. That's good. I qualify for more than 200,000. Let's go 300,000. Ooh, that's a little higher. Let's adjust. 270. Bingo. So now I know I can qualify for about a $270,000 loan. Now, what does that mean when I can buy? Well, whatever you save up, you just got to get to about a $270,000 loan amount. Depending on some markets, 270 is a lot and goes a long way. If you're in the market like Chandler, Arizona, Los Angeles, Miami, 270,000 doesn't go that far. So, use everything at your discretion. But now let's go over to Redfin. I like Redfin a little better than Zillow. And I'm just going to search in the Phoenix area. Let's search for a price around 300,000. I know the loan amount's 270, but let's go 300. And oh, this one's kind of nice. Looks like a nice little townhome or a condo. Yep, there's a little townhome. Oh, this one opened in a different window. Let me get it in here. Here's a nice little condo or townhome. And here's where I can now find details. And this is why I like Redfin a little bit better, because they have estimated payments for everything, right? So now remember, we're dealing with around $2,150 for that housing payment. Well, $2,150 minus $150 for the HOA leaves me $2,000. $60, we'll say, for the homeowner's insurance. So I'm down to $1,940. And property tax is another $20, so $1,920. So remember, when I went and did the calculation for what I thought the mortgage would be, I was around $270. Well, for this specific townhome, that $270 is pushed up quite a bit. And now I know kind of the range I'm in, right? Hopefully that's making sense. I know this is a lot of information. Feel free to ask questions. But all we're doing is we're kind of estimating what price range do we qualify for. Let's find another property. This one's 300,000. I'm not showing, I don't know who has these listings, so don't get mad at me because I'm not showing off your listing. But here's one. It's in Phoenix. And if I scroll down to look at the payment, remember $2,150 is the goal. And ignore the principal and interest. That's the one we calculated on our own. Okay, $93. We'll call it, for the sake of argument, $90. And so $2,150 minus 90, $2,060. Minus 81, we'll call it 80. So $1,980. So we can now qualify if we wanted this house, because there's no HOA. We now qualify for, even though $270 was our rough estimate, we can push it up another couple $100 because taxes and insurance isn't that much on this specific property, right? A lot of this is going to be dependent on the property you choose. That's pretty much it. So we protected our privacy. We checked our own credit. We calculated your own debt to income ratio. I didn't put this up. We estimated your housing payment that you can qualify for. And now what's next? Well, all that's really next, start saving. Save for your down payment, save for closing costs. How much do you need to save? Well, that's going to depend. If you go FHA, 3.5%, that's the minimum you have to put down. If your credit score is under 580 but above 500, you got to bring 10% to the table. If your credit score is above 620, you can go conventional. And a first-time home buyer on conventional can actually bring 3% down. However, I'd recommend 5%. So let's take it back to that $300,000 house. Well, what does 5% look like? $15,000. Pretty easy. Now, I'm not saying it's easy. $15,000 is a lot of money. I'm saying it's pretty easy to calculate. Once you've established how much you need to save for the down payment, don't forget about closing costs. That's the kicker people forget about. Hey, I needed $15,000. I saved $20,000. I'm ready to buy. Not quite. Yes, we can get seller credits, but you don't want to you don't want to live like you're going to get those automatically. You want to live like you're not. And if you get it, all the better, right? No one's going to be upset getting into a house with money still left in the bank, which is the goal. So how much are closing costs going to be? It's going to depending on the county and state you're in. Arizona, for a $300,000 house, you can expect between $6,000 and $8,000 of closing costs. There's title fees, insurance, taxes, recording fees, etc. And then, of course, lender fees. But that's about for Arizona. Every state's a little different. Every county is a little different. But make sure when you're saving up, save up for the down payment, save up for the closing costs as well. And then if you're like, hey, I think I'm in a good place. I qualify for a house that kind of fits what we need. It might not be our dream home, but it fits what we need. We're getting out of the apartment. We're upgrading, whatever the story, we're relocating. I've done this. I've followed along. I qualify for, let's say, this $300,000 house. Perfect. Your next step, gather your documents, come talk to me. If it's a state I'm not licensed in, then go talk to someone else. But talk to a loan officer, right? You did the preliminary work. You did the work to know that, hey, I can do this and it fits within my means. Now let us double check and verify, right? We'll see things that you might miss, not because you're incapable, it's just because we see everything every day. I only know the pitfalls because I've seen people go through the pitfalls, right? Rely on us for that process. And then the other piece I do want to say, the exciting part, start shopping wisely. Get with your realtor. You know, hey, the loan officer verified everything. I've double checked everything. I know the price range of the area I'm looking in. Now let me go take that information to the realtor. And now the realtor, because you basically armed them with the best thing you could, which is all the information they need, should find you something pretty quick. Now, I've talked about this in previous live streams and in a video. Just because you can qualify for that $1,900 payment or the $2,100 payment doesn't mean you should. And always keep that in mind. Give yourself some buffer. Property taxes go up. Insurance goes up. You want to put yourself in a position where 5-10 years from now, you don't want to be stressing because now insurance is $600 more a year or taxes went up $1,000 a year, which does happen in some counties. Well, cool. Thank you guys for hanging out. That was a little bit longer today, just about a half hour. Hopefully you found that helpful. As always, if you need anything from me, please don't hesitate to reach out. Otherwise, have an excellent Friday. Have an excellent weekend. Go Bears. They play tonight against Kansas City. It's preseason, but I'm still excited. And I'll see you guys next week.